welcome to Retirement Hack Unlock Hidden Investment Power with SDRA or Solo for 1K. My name is Leah with Sense Financial, and we are a boutique financial firm specializing in self directed retirement accounts with checkbook control. Our presenter today here with me is Brett Sininsky. I briefly want to introduce Brett. He is a Solo for 1K and SDRA consultant here at Sense Financial. He has a professional journey spanning over 18 years in real estate investing. Brett is also a licensed California real estate agent, and his passion lies in empowering people to attain financial independence, affording them a possibility of an early retirement. So, again, thank you for joining us today, Brett, and I'll let you take it from here.
All right. Yes. Thank you, Leah. Let me know you can hear me okay.
Yep, I can hear you just fine.
And you can see me okay.
Yes,
All
perfect.
right. Excellent. Well, yes. Welcome, everybody. Thank you so much. Going to move you guys to the other screen. We are covering a little known retirement hack. And the subtitle is Unlocking Hidden Investment Power Using the Self-Directed IRA and what we call the Ultimate Retirement Plan, which is the Solo 401k. And why is it ultimate? Well, you're going to have to wait a few slides from now to see why it's ultimate. Since more people have joined in the last 30 seconds or so, please, we are just getting started. Please type in any questions you have as I'm going through this. It doesn't matter if I cover it in the presentation after you ask it, it's fine. I'll cover it again if I have to, so don't be shy. That is me and my contact information. We are not at Sense Financial a fiduciary. We do not provide legal, tax, investment, accounting, or other professional advice. If such advice is needed, please seek out the proper expert in that field. All right. Well, why us? First of all, the diverse group of people you see is representative of, we just have clients from all different walks of life, different businesses, different employers they work for, different investment preference, all kinds of people. And most of our clients come from referrals, and most of our referrals come from our existing clients, which tells us that we're doing something right. Now, we also have 5-star reviews all over the place: Trustpilot, Better Business Bureau, Bigger Pockets, which if you haven't checked out biggerpockets.com and you are interested in primarily in real estate investing or lending, syndication, evaluating deals, I would highly recommend that website. It's forum-based. It's kind of like Facebook for real estate investors. And it's been a great resource for us over the years, not only in getting clients, but also providing value in the forums in answering questions. So we are on there all the time. And then, of course, Google, you can look up us on Google and Yelp, and there's reviews there. So before you do business with a company, do what most people do and check the reviews. And we're not shy about saying that because we have really good reviews. And we pride ourselves on that. Our mission is to help clients obtain control of and protect their retirement accounts. You work hard for your money, and we want to come alongside you and work hard for you as well in this capacity of providing a vehicle that will allow you to do exactly what our mission states. Unlock your retirement account, jailbreak it, the hack I'm talking about, totally legal and above board, and protect it, because through diversification and safe investing while aggressive at the same time is a way to protect and grow your account. Proverbs 21:5 says, good planning and hard work lead to prosperity. Indeed. So there's two different types of investing, two different ways of investing, essentially. To kind of simplify it, I'll use a parallel that we can all relate to. Conventional on the left is the bus. The bus stays on a track. It drops off at certain times in certain places. You have to take other transportation or walk or ride your bike or whatever to get on the bus, on the train, at a certain location. And then you have to get off the bus or train at that location and get to your next destination or your final destination. That's the conventional side of investing. Does it serve a purpose? Absolutely. It's great. I love taking the bus. I can read, I can listen to something, I can take a nap, and I can get to my location, almost to my location. Not quite, because my location is not the bus stop. It's where I'm going after that. However, it still serves a purpose. That's conventional investing. Think Wall Street, think Vanguard, Fidelity, Schwab, maybe the money you have invested with your financial planner. Stocks, bonds, mutual funds, and ETFs primarily. Okay. On the other side, you have the off-road vehicle. Now, this vehicle can pretty much go where the bus goes. It can definitely go over the train tracks. Wouldn't recommend driving it on the train tracks, down the train tracks for safety reasons. It could if you wanted to, though it's certainly illegal. So stay within the legal guidelines, which we always would advocate. But the off-road vehicle can go off-road. It can go on the highways, it can go on the streets. It can go over grass. It can go over rocks like you see there. It's got a higher clearance, different suspension. And that's your self-directed accounts. It's kind of like the Wild West because the IRS actually is, and Congress really at the end of the day is who has dictated and currently dictates where you can invest. And the Department of Labor is involved when it comes to prohibited transactions. We'll discuss here in a few slides, but what you can invest in and who you can invest with is already preset. It's the custodian, Schwab, Vanguard, Fidelity, whoever your financial planner uses, that actually restricts where you can invest. Why is it Wall Street primarily? Well, it's simple. It's easy to manage. It's easy to get fees based on assets under management. And so that's why people don't talk about the self-directed realm, because a lot of times they realize they don't necessarily need to pay somebody else to manage their money, because in the self-directed realm, you can invest in things that you already know. Most of our clients are already real estate investors. They're already private lenders. They're already investing in real estate syndication opportunities. They're already investing in crypto or precious metals. So they don't need somebody else's expertise to guide them. And not that they shouldn't seek more education in the realm that they already think they know. Absolutely. We never stop learning. But in the self-directed realm, if you understand buy and hold real estate, you can invest your IRA or 401k into buy and hold real estate that you already understand. And because of that, it's a pretty safe, although robust investment opportunity. And so I'll talk more about what you can invest in here. The self-directed account really, truly does provide true diversification. Why? Because there's no way to exhaust the list of what you can invest in. I can tell you what you can't invest in, and it's essentially four things. That is collectibles, baseball cards, stamps, some precious metals are allowed, some are not. Art, cars, wine, those are collectibles. You can't invest in those. And the other thing is life insurance in an IRA. It is possible to invest in some forms of life insurance in the solo 401k, though most of our clients are not looking to do that. And then the other one is S corporation stock, because you have to be a human to invest in S corporation. But you can still sponsor a solo 401k with an S corp, but I'm getting ahead of myself. Don't want to confuse people. And then the other one is you just have to be mindful of who the disqualified parties are, you and your immediate family, and what can create a prohibited transaction. You want to stay away from those. And so those are essentially the four things: prohibited transactions, life insurance, collectibles, and S corporation stock. However, here's some of the common investments: real estate, both residential and commercial, tax deeds, trust deeds, mortgages, first mortgages, second mortgages, third mortgages, whatever you want. People buy on the courthouse steps, at auction, sheriff auction. People flip inside their accounts. We'll talk more about that. You can invest in precious metals, as I mentioned. See if I can remember the list: gold, palladium, platinum, and silver, I believe, is the list of approved metals. And then you can become a private lender, of course. Many of our clients are private lending, whether they're originating the loans themselves or actually or just investing in like an existing mortgage fund. Either way works. Ecclesiastes 11:2 says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on the earth. And we have been very blessed in this United States of America for many years since our founding. But we've had our ups and downs, right? 2008-9, we had COVID, which was kind of a little blip on the market here, and then everything kind of went crazy. But something's coming. And the people who were diversified, in other words, they didn't have all their money in Wall Street. I'm not talking about invested in a mutual fund in the tech sector, in the S&P 500, and overseas international stocks. That's a form of diversification, but it's still in Wall Street. It's still in the same asset class. I'm talking about maybe some money in Wall Street and maybe some money in real estate, possibly crypto. I don't know. I always say invest in what you're comfortable with and educate yourself before you make an investment. But this allows for true diversification, as I mentioned. A quick example, Brad and Jennifer, real estate agents out of Phoenix, Arizona, came to us several years ago and said, hey, we're selling houses. We're doing really well. I've also got, we're self-employed. I've also got some money set up in in an IRA, rollovers that I was, from a former employer 401k. I've heard about this thing called a self-directed IRA. Well, we actually introduced Brad to the solo 401k. So he and his wife, both being self-employed for the same real estate business, are actually participating in the same solo 401k plan. Once he heard about the solo 401k versus the self-directed IRA, it was really a no-brainer for him, which I will explain as time goes on here. And his goal, though, was diversification. And what he was able to do is not necessarily take everything out of Wall Street. He certainly took most of his money out of Wall Street and put it into real estate. But as a result, he maxed out his Roth solo 401k. They've got millions of dollars in real estate, some cash inside their solo 401k Roth account, and they're already over 59 and a half, by the way. So that means tax-free ATM withdrawals whenever they would like. Additionally, they can distribute an asset to themselves as well. So one of these rental properties that they have, whether it's multifamily or single family, they could actually deed the property to themselves and distribute it to themselves from out of their 401k and not incur any taxes for that distribution. They could live in it. They could keep it as a rental, investment, whatever. Now they own it personally and they can pretty much do whatever they want with it. So super cool. The power of the Roth is unbelievable, but the power of self-directing is also unbelievable. The Roth is just like a whole nother level. Okay, so what are the options? Well, we offer two. IRA, 401k. Okay, self-directed IRA. It's also a self-directed solo 401k. You can have an IRA at Vanguard. You can have a 401k through your employer or through Fidelity, but you're not going to be able to self-direct. Yes, they will call it a self-directed account, possibly because their definition of self-direct is pick one of these or whatever amount of these stocks, bonds, mutual funds, and ETFs you want. Well, that's not truly self-directed because you're stuck there, right? We want you to be able to invest in whatever the IRS allows, okay? And we just kind of went over that, right? So you can do that with a self-directed IRA or a truly self-directed solo 401k. Self-directed IRA does not have a self-employment requirement tied to it like the 401k does. So you can anybody can do a self-directed IRA. Now, typically, you've got a fair amount of money that you're going to roll into a self-directed IRA from an existing plan. There's two ways to fund an IRA or 401k for that matter. That's through contributions or through rollovers or transfers from one IRA to another IRA. But essentially, those are the two ways, right? Of course, I'm talking about funding. I'm not talking about returns from investments. That's another conversation. But rollovers and funding. And so because the maximum contribution limits for an IRA in 2025 are only $7,000 if you're under, $58,000 if you're over, generally people have a fair amount of money in an existing retirement plan that they're going to unlock and roll into the self-directed IRA. Because if you want to do alternative assets, you need more than $8,000 typically. And don't get me wrong, there are some crowdfunding opportunities, maybe even some private loans you could execute for less than 8,000 or whatever. But typically, it really depends on what your goals are. Typically, most people have 20, 30 at minimum that they're going to roll into the account. Not so with the solo 401k. First of all, you do have to be self-employed. I'll talk more about that on the next slide. But the contribution limits are much higher, literally 10 times the amount of the IRA. So not all of our clients, when they establish a solo 401k, roll over existing retirement funds. Many of them just fund the 401k from contributions because, like I said, 10 times the amount, 70,000 versus 7,000. So if their business is robust enough, we'll break down the contributions and the way they work on a couple slides from now, then they can max that out and really add up a lot into the solo 401k in short order versus the IRA. So how does the checkbook IRA work? Well, first off, you need a new custodian because the current one you have is only allowing for Wall Street. So we open a new account on your behalf with an IRS approved custodian that allows for alternative asset investing. Once that's done, we set up the transfer. Now this transfer or direct rollover, kind of same term. When it's IRA to IRA, it's called a transfer. When it's a rollover, it's usually from a 401k. But it can be from a 401k, it can be from a 403b, a TSP, an IRA, any retirement account, Roth or pre-tax, can move into and become a self-directed IRA. So we set up the transfer, plan on 1 to 2 weeks for that transfer, by the way, depending on the custodian. We also create a special purpose LLC. Now, there's two types of retirement accounts, self-directed accounts, especially in the IRA realm. There is a checkbook IRA, which is the only type of self-directed IRA we do. And then there's what I call a full custodial IRA. Now, you still have to have a custodian with all IRAs, but we bypass them with the use of a special purpose LLC. Now, if you have your IRA at Vanguard, they are the custodian, right? You go through them for all investments, even if it's just stocks, bonds, and mutual funds. You go through them. They have to execute it. You kind of like pull the trigger online, but they are part of the transaction. Now, it's the same thing with a self-directed IRA. If you want to buy real estate or crypto or precious metals or do private lending in a self-directed IRA without checkbook control, you have to go through the custodian for everything. They are on title. The custodian is on title for all investments, real estate or otherwise, for benefit of FBO, your IRA. Okay, Joe Smith IRA. All right. Now you go through them. It could be an online portal. It could be a phone call you have to make. But either way, you have to get the documentation to them. They have to execute it, which causes red tape, transaction fees, and it can cost you a lot more to have a non-checkbook control IRA than it does to have checkbook IRA. Not to mention the red tape and the transaction fees. Excuse me, not to mention the red tape and the time it takes. So we specialize in checkbook control accounts with both the IRA and the 401k. For the IRA, again, a special purpose LLC is created. All the assets are held inside this LLC. The cash, the real estate, everything. Now, you can create multiple LLCs. Most people don't do that, but you can. And this special purpose LLC is single member. Who's that single member? The IRA. You are a non-member manager. That's what gives you the checkbook control over the funds and the assets inside this LLC. That's what allows you to sign on the dotted line. That's what allows you to not have to go through the custodian to do a transaction, because you're not doing it at the IRA level. You're doing it at the LLC level, of which the IRA is the only member. So also with that LLC manager checkbook control, you can open a bank account. Now we assist you with this. A bank account is opened. The transfer goes from custodian to custodian. And once everything is set up, the money is transferred from the custodian automatically. You don't have to pull the trigger on this, but automatically, usually within 24 hours, from the custodian into that bank account. So within 3 to 4 weeks from start, you're able to self-direct. Okay. Now, once you start self-directing, all the income and all the expenses must go into and out of that bank account. That's the easiest way to think about this, right? It stays in the IRA. It doesn't go through your checking account first, or your dad's, or your friends, or anybody else's. It's just, if you get a rent check from a rental property the IRA owns, that the IRA LLC owns, then that rent check is deposited into that bank account. Okay, until that money is deployed into another investment, the bank account is the home for the funds. All right. So how does a solo 401k work? Well, first of all, I already mentioned this. You do have to have self-employment activity. What does that look like? Well, any number of things. Legitimate self-employment activity, not passive income that you're living on, actively earned business income. It could be short-term rental income. It could be real estate agent income, commission income. They're activity is active, right? It's about the activity, not the income. But you could you could join a network marketing company. All of a sudden, you're self-employed, drive for Uber, uh, whatever, sole proprietor, corporation, LLC, partnership, C Corp, any type of S Corp, any type of business setup can actually sponsor a solo 401k plan. Now, one thing to note, you cannot have any full-time W-2 employees that are not an owner or a partner or a spouse. Okay. And then once we establish that you qualify for the solo 401k, if you're ready, the plan sponsor, that's your business, adopts the plan. An adoption agreement is created, which is the plan, and then the trust is created. And so instead of an LLC, it's a trust structure. So you are the trustee of this plan, which is a trust itself, which gives you that checkbook control. Now, there is no custodian requirement for a solo 401k, for any 401k, like there is with the IRA. So we don't have to eliminate them with the trust like we do in the IRA with the LLC. It's just not required. And we set you up as the trustee, and so that you can make investment decisions. You can open up the bank account with our help, and you can open up an account at any financial institution or brokerage, actually. One note on that comes up a lot. You're looking for an investment. What do I do with the money? Like, I don't want it just sitting in this checking account, not earning anything. Well, you have a couple options. One, let's say that you first establish this account, okay, and you have, let's call it $100,000, and you want to buy a rental property that you know is going to cost like 80,000. Okay. I know these may not be real life numbers for the market you're in or that you're considering, but just bear with me here for sake of demonstration. So you don't want to roll over 100 or even the 80 because you're still hunting for this property, right? And by the way, set up the plan first, IRA or 401k, and then start hunting for real estate. Don't do it the other way around, because once you find the property, got to be able to pull the trigger fast or it could be gone, especially if it's a good deal. I think you all know that. So set up the plan first, and then instead of rolling over the 80 or the 100, just roll over like 10,000, enough to get the earnest money deposit for the real estate and maybe pay for the home inspection or the appraisal or both. And then during this period while you're under contract to close, you have enough time to transfer or roll over the rest of the funds needed to close on that investment. Okay, so that's one way that you can do this when you're kind of just establishing the plan. And by the way, there's no limit to the rollovers or transfers from one IRA to another, or one 401k to an IRA, or whatever. You can go either direction as many times as you want, and there's no limit to the dollar amounts you can do. Okay, so that's one thing to note. The other thing is, if you are, let's say you roll over the 100. Actually, yeah, let's say you buy an investment property, and when you started, you only had like $5,000 in your account. Excuse me. After you closed on the property, you only had like 5 or 10 grand in the account. You're okay with that, right? Because you need some cushion to pay some bills in case something breaks or whatever. So that's not a bad thing. But over time, you're getting these rent checks, right? More and more rent checks. They're going into the account. So now the account has ballooned to like 50 grand. And you're thinking, man, this money's just sitting in this checking account, like earning a nominal interest, like 1% or less. Well, what can I do with this money? It's not enough to do what I really want to do, which is buy another rental property, even if I get a loan. And we'll talk more about how to get a loan later. But I also don't want 50 grand sitting in this checking account, not really working. I mean, I'm going broke fast doing that, or going broke safely, however you want to look at it. Not even keeping up with inflation. Well, what you can do is you can also open up an account, like it says there on the screen, at any financial institution. Okay, this could be a financial planner you open up an account with in the name of the solo 401k. It could be Vanguard, Fidelity, Schwab, whatever. And so you're going to transfer some of the assets from that checking account into the brokerage account that you opened up in the name of the solo 401k. And now you can move some of those assets into the S&P 500 or money market or short-term corporate bond fund or whatever you want to do, ETF, stocks, bonds, mutual funds, until you find the next investment, and then you can move that money. Again, it's all in the solo 401k. You're not doing like a direct rollover now. You're just transferring money. You're liquidating the assets in the Schwab account, and then you're just transferring them via wire transfer from Schwab or Vanguard or Fidelity or wherever back into the solo 401k checking account when you're ready to pull the trigger on an investment. So that question comes up all the time. So I like to get ahead of it. Just like the IRA, all the income and expenses related to this should go into and out of that checking account. Okay. All right. I'm going to skip that one. Okay. How do the contributions work for the solo 401k? Well, first off, if you're over 50, actually, the next slide breaks this down a little more, but you essentially have two types of contributions you can make for the solo 401k. The IRA, it's real simple. If you have earned income, you can contribute up to 7,000 or 8,000, depending on your age. Roth IRA, traditional, they have the same limits, right? You can do both, but they both have the same dollar amount limit. With the 401k, you're an employee and you're an employer as a self-employed individual. Again, it doesn't matter if you're a sole proprietor, S Corp, single member LLC, partnership, whatever. You and your wife can both be part of this. All the benefits I'm mentioning, by the way, can double for a married couple. Okay. So the next slide breaks down how these contributions work. But before we go there, another verse from Proverbs 21:20, the wise man saves for the future, but the foolish man spends whatever he gets. Something we should all remember from a very young age. Why is my slide not skipping? Okay. Contribution limits. Well, here you go. So the employee contribution up to $23,500 per year plus a $7,500 catch up if you're over 50. And this can be up to 100% of your self-employment earnings, essentially. Meaning it's dollar for dollar, right? You show the income, you can contribute it. Could be pre-tax or Roth. And if you are an S Corp running payroll or C Corp running payroll, then the contributions need to be done through payroll, so they reflect on the pay stub and the W-2. And they really, the contributions should be made within 7 days of paying yourself. Okay. Now, the employer profit sharing contribution is the other hat that you wear, right? You're the employer and the employee. And so this is a percentage, profit sharing, employer contribution, kind of the same thing. Now, it's always a tax deferred contribution. It's always a business expense for the business. You can make it Roth by just quickly doing a conversion on it, essentially, is the easiest way to do it. And then you'll get a 1099 for that income. But it starts out as a tax deferred contribution. So this is 25% of your self-employment compensation, or 20% if you're sole proprietor or single member LLC of the profit of the company. Okay. Now, for under 50, it's 70,000 for 2025, 50 plus, and then there's this little blip here I'll talk about called a super catch up, but 50 plus and then 64 plus, 77,500. And then between ages 60 and 63, you actually get this super catch up of 11,250, which is equal to 81,250. So again, if your business is earning enough income, you can maximize these contributions. And then for 2024 is 69,000 and 76,500 for the catch up. So you can use leverage. It has to be a non-recourse loan, which means you can't provide a personal guarantee because you are a disqualified party to the plan. You cannot guarantee that a loan's going to be paid back. You also can't use your credit and income to be part of the qualification process of the loan. And the property has got to cash flow a little bit, a couple $100 a month. It's going to require 30 to 50% down. If there's a default situation, then the property is the only thing that the lender can go after. It's the only security for the loan, right? They won't ding your credit. They won't put a lien on your primary residence or garnish your wages or do anything like that, right? It's the property is the only security. It's a little more risky because of that. So that's why it requires more down. And you do need about 6 months of reserves typically. We do have a list of lenders on our website that you can look through that have different terms and conditions. I recommend you check that out if you're interested in a non-recourse loan. And by the way, that is SenseFinancial.com /non-recourse-lenders. Okay, who are the disqualified parties? You and your immediate family. All right. This is like a AI image I created with a family. Anyway, so it's you, your spouse, okay, and it's the lineal descents, right? You, your spouse, your parents, your grandparents, and also your children and their spouses. Okay. Now, you might say, hey, married couple is not lineal. Well, Bible says two shall become one flesh. Okay. Well, the IRS says the same thing. So when you get married, you're the same person in regards to this. All right. So those are the disqualified parties. What does that mean? Well, it essentially means you cannot provide services. None of these people can do any of this. Okay. Provide services to the plan or any of its investments. So think about what you can do stuff, right? You have to be able to pull the trigger on investments, but think white collar versus blue collar. White collar is okay, blue collar is not. So you can't swing the hammer, but you can hire the person that's going to swing the hammer. All right. That's the easiest way to think about providing services. The other thing is you cannot get compensation. You cannot be compensated for anything the IRA owns or manages or invests in. At all. Okay, so that's another prohibited transaction. These people that I mentioned, and then the other one is you cannot invest in a company that any of these people have a controlling interest in. And by the way, that's 50% or more. It's really best to just stay away from investing with any disqualified parties at all, even if technically there's an opinion letter from the IRS or Department of Labor that says that you can. It's just best to keep at arm's length for a lot of reasons. I don't know about you, but when investments go sideways and it's with family, I don't want awkward Thanksgiving dinners or no Thanksgiving dinners with those people anymore. So just, I say, keep at arm's length, do what you will, but understand how the disqualified persons work and the prohibited transactions. All right. It's easy to stay away from and stay within the guidelines if it's always arm's length. Okay. Um, and I'm not going to go through all this, but it is actually not too late if you haven't filed yet to establish a solo 401k and make contributions for 2024. Depending on the type of business you make, you can either do employee plus profit sharing, or you might only be able to do profit sharing. Okay, so feel free to pause the screen later on the recording or take a screenshot of this and you can read through it. But happy to answer any questions on that. And then this is a screen that just shows the breakdown of the different accounts. Self-directed IRA is the one, again, that we don't do. That's without checkbook control. IRA LLC is what we do, checkbook control, and then the checkbook solo 401k. They're all similar when it comes to what you can invest in. The major differences are the solo 401k has a participant loan option, so you can actually borrow up to $50,000 or 50% of the total plan value, whichever is less, and use it for virtually any purpose. So one of those disqualified parties or prohibited transactions we were talking about you could actually use the participant loan and then invest with one of those people that would otherwise be a prohibited transaction. It's your money once you borrow it, right? You still pay it back at an interest rate of prime +1, but and that's over 5 years, by the way, or 15 if you use it for a primary residence. The solo 401k does not have any tax, unrelated business income tax on leveraged real estate with a mortgage. The IRA does. That's kind of a rabbit hole that I'll get into if someone wants to ask about it, but I'll leave it at that. So if you're going to buy real estate with a loan, you are better off doing it in the solo 401k than you are in the IRA if you can. And then the max contribution, of course, is way different for the IRA versus the 401k. And then the other thing I didn't talk about is the Roth component. So a self-directed IRA, or any IRA for that matter, is either Roth or pre-tax, but it's not both. The solo 401k can be Roth and pre-tax. It has both built into it. Okay. So because our plans have that, It's a lot easier in the 401k to do Roth conversions because they stay in the same plan and essentially make Roth contributions in much higher limits because you can go straight through the front door if you want. And also, the contribution limits are so much higher. Like that entire 77,500, if you want it to be, could be a Roth contribution. Now you're going to pay taxes on it this year, but no taxes after that ever on the principal contribution or the investment money earned. So the Roth is awesome. The more money in Roth, the better. And then, of course, the 401k has that self-employment requirement tied to it. If you do want to jump on my calendar, feel free to SenseFinancial.com/consultation. Happy to answer any questions you have. I'm also happy to take any questions that we have here today. So without further ado, let's see what questions we might have, Miss Leah.
Yes. So for today, we actually have a few pre submitted questions, and so I'll read those out. The first question is: can I invest in an Airbnb or short term rental with my SDRA?
Yes, absolutely. That is allowed. Again, anything except for collectibles and life insurance in the IRA and S corp stock and the disqualified parties we just talked about. Now, the one thing I will say is, if you're going to do short-term rentals, you really want to talk to a tax advisor before you do that, because depending on the term of the rents, less than 7 days, and depending on what kind of services you're providing, like tours, daily maid service, that sort of thing, um, all the income from the short-term rental can actually be classified as business income and therefore is not passive and therefore actually triggers the UBIT tax that we were talking about. So I would want you to understand what that looks like before you pull the trigger on the short-term rentals, but it's definitely allowed.
All right. The second question is also pre submitted. Can I convert my traditional SDIRA to a Roth SDIRA?
Yes, you can. Um, I would suggest that if you're, so two things. One, if you're self-employed and you qualify for a solo 401k or you're not sure if you do, let's talk before you do that. If you're going to do a self-directed Roth IRA and the only thing you have right now is a self-directed, is a traditional pre-tax IRA, do the conversion where it's at right now. So if it's a pre-tax IRA at Vanguard, do the conversion at Vanguard because they're not going to, there's no charge for them doing that, right? Because again, a self-directed IRA is either Roth or it's traditional pre-tax. It's not both. So if you move the money to a self-directed IRA as a traditional IRA and then you want to convert it to a Roth IRA, well, now there's some creative ways to close the one and open another, but it's easier to just do it at the current custodian that it's at before you create the plan, because you don't want to incur any hassles and fees and separate LLCs that need to be set up and everything. So hopefully that makes sense, but it absolutely can be done. But it's much easier in the solo 401k because that traditional IRA can roll into the solo 401k, and then you can do the conversion within that same plan very easily. You're the plan administrator. You don't have to go through a custodian for anything like that. In the IRA, you do, whether it's at Vanguard or self-directed or whatever, you still have to go through the custodian for things like that, for the conversions. And so there's a little more work to it. The other thing to note is if you are going to do a conversion, consider converting an asset instead of cash, because if you do something like a trust deed, you actually have to get a third-party valuation, and the valuation can come in at a significant lower amount than the principal investment. And so you can kind of hack your way, so to speak, um, to more money in Roth for less taxes paid, right? So think about it like this. There's three ways to get money in Roth: straight Roth contribution, Roth conversion of cash, or Roth conversion of an asset. Now, if that Roth conversion of an asset is an illiquid asset, meaning you can't just sell it tomorrow and turn it into cash like you can with stocks, bonds, mutual funds, it's got to be illiquid, right? real estate is an example of an illiquid asset, but it's probably not the best example for this because it has appreciation and such. A trust deed, a mortgage note, is a great example because it's illiquid. It's locked up for a certain period of time, 5 years, 30 years, whatever it might be, 6 months. But so it's not easy to turn into cash, but it's also, it's because it's illiquid, it's going to come in at a valuation of less than what it might, the principal amount is actually what you put in. So hopefully that makes sense.
All right, thank you, Brad. We still have a few more questions here. The next one is regarding solo 401k. Can I use my solo 401k to buy real estate with leverage?
Yeah. So we did talk about that a little bit. So thanks for the question. You actually can definitely use what's called a non-recourse loan, as we mentioned. And then you can see that list of lenders on our website, SenseFinancial.com /non-recourse lenders. And just talk to them. Look at, we have on that landing page, on that page, we have some of the terms and conditions that they offer, but you should always call them to find out if that's everything.
All right, and I think this would be the final question for today. How does the IRS audit solo 401ks?
Oh, good question. Actually, I'm glad you brought that up. Well, they would audit a retirement account essentially the same way they would audit your tax return, right? It's different because there might not be a tax return that you filed, but they're still going to look through your accounting, your books, and everything. Now, it's a better question is what's going to trigger an audit? Well, what's going to trigger an audit is you committing a prohibited transaction, right? Now, it is somewhat an honesty game here, right? You're being honest with what you're investing in. You're being honest that you're not buying a rental property in Arizona because your daughter is going to school there and going to stay in that rental property. She's a disqualified party. She can't stay in that rental property. Neither can you and your spouse and your other immediate family. So that's something to bear in mind. If you do that and the IRS gets wind of it, that's gonna trigger an audit. In the 401k, it can trigger an excise tax of 15% on the dollars that are used for that prohibited transaction and the earned income from it. But in an IRA, it can and usually does actually disqualify the entire IRA, not just that investment or the money tied to that investment. So this is really something that you want to stay away from. If you're going to push the envelope, I'm not talking about breaking a rule like the example I just gave of, having your daughter live there. That's a clear violation. But if you're going to push the envelope and read opinion letters and such, and the IRS hasn't necessarily ruled, but they've kind of given an opinion, or maybe they haven't, and you want to invest in a business where maybe that business is going to loan money to a disqualified party, but it's like third removed and this low percentage because the money that they're loaning is not 100% going to that disqualified party. Maybe it's like 20% going to that disqualified party, and the other 80% borrowers are not disqualified parties. There could be some gray area here. If you're going to do that, just limit the amount that's inside this IRA. So that way, whatever's in the IRA is all that's at risk. But I say just stay away from that. It can really trigger a lot of things that are very unpleasant. So thank you for asking that question.
All right, thank you, Brad, for answering that. I think those were all of the questions for today. Before we conclude, would there be anything that you'd like to add?
Thank you, everybody. Really appreciate your time. And if you do want to get on the calendar, just let us know. I will actually just, for y'all that are still here, you can go to SenseFinancial.com /consultation, and we're happy to have a conversation. It's not a hard sales pitch or anything like that. We're just getting to know what's going on in your world and your goals, and kind of guide you from there. So thank you very much, everybody. Appreciate it.
Thank you, everyone. I hope you enjoyed the webinar, and yeah, we'll see you next time.